again, everyone. It is Wednesday, June 29th, 2022. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts, data series, and our own internal models that I think are the most important to watch right now and are likely to be the most influential on U.S. stock market direction over at least the next several weeks and possibly through the summer. So let's begin. Number 1, market internals. The Asbury 6 remains negative. So for those who know me through StockCharts.com or through Asbury Research or some of the other places that I appear around the internet, the Asbury 6 is one of 2 tactical in-house models that we have here at Asbury to try to determine what the internal condition of the market is. And the reason that we built the Asbury 6 was because the character of the S&P 500 has changed quite a bit, in my view, over the past several years or more. You're seeing a lot of day-to-day volatility, where the S&P 500 is up 100 today, it's down 100 tomorrow, it's up 60 overnight, and then it's down the next day. Watching it is enough to make you a nervous wreck, and worse than that, it can really force you into mistakes, really get your fear and greed buttons going. So we built a model that would tell us on a daily basis what's going on with the S&P 500 kind of under the hood. I like to equate this to when you go for your annual checkup at your doctor. So he watches you come into the room and hair's combed, nice shirt on, you look great. He sits you on the table and he starts checking your blood pressure and your pulse and your reflexes and listening to your heart and lungs. He may get a different view than what was apparent when you were coming through the door. And that's what the A6 is supposed to do and does do for the stock market. Let's have a look at it. Right now, the Asbury 6, and you can see there's 6 different constituents. The way we put this together is every indicator has an Achilles heel. There's no indicator that always works all the time. Certain market conditions make some indicators ineffective at times. So what we did is we started with what I thought were the most important tactical tools that I have used throughout my career, and we started to test them with each other as sets. So when we started, we really didn't know if this was going to be the Asbury 3 or the Asbury 10. We ended up with 6 indicators excuse me, that do a really good job of picking each other up when one indicator fails, when one indicator's at a spot where it doesn't really give you a good signal. And we ended up with 6. 5 of these on purpose have nothing to do with the S&P 500. And we did that so we're not getting jerked around by the algorithmic trading and the day-to-day volatility of the S&P 500, which more times than not is just noise. So you can see right now, the Asbury 6 has 4 red or negative constituents. And these are the dates that each of these numbers in the cells are the dates that each of these constituents actually turn to negative. So since June the 10th, we have been negative, and there's only 2 positive right now. It would take a total of 4 green individual metrics to turn the status of the Asbury 6 to positive. So you can see here's the indicators thus far this year, here's the signals thus far this year, and the A6 kept us on a defensive note for most of the year. We went negative on Jan 14, positive on March 17, back to negative April 12th, positive just for a short time on May 26th, when it tried to and couldn't break this 4170 area in the S&P 500, which I actually pointed out on the last Your Daily 5 that I did just a little over 2 weeks ago. And then finally, here's your June 10th. So again, as long as this is negative, it's telling us to play defense. Playing defense means different things to different traders and different investors. For me, it means maybe take some money out of the market. Tighten your stops. Take a look at what your holdings are and maybe start to shed some of those underperformers and leave the ones that are still performing okay, leave those be. So number 2, technology is at a major decision point. One of the reasons the market has been so weak this year is it's lacked any sustained leadership. Usually in a bull market, in a strong market, you're going to get some leadership from semiconductors, you're going to get some from tech, and sometimes you might get some from small cap. We haven't had any of that this year. So here's the NASDAQ Composite Index here up top with its 200-day moving average going back to January. And it highlights this important support level that actually originates off the chart. I wanted to show you the detail here, so I just drew those lines in. It represents the September and November 2020 lows from 10,823 to 10,519. We first came down right in the middle of May, tested this level, had a little bounce up to the June 2nd high, came down again in the middle of June, and we're trying to rally off it again. The market obviously sees this as an important level. Down the bottom here, this is the relative performance of the comp versus the S&P 500. In this case, we use SPY, the ETF. And what you can see here is since the beginning of the year, this actually originated late in 2021. We've been in a trend of quarterly relative, the comp has been in a trend of quarterly relative underperformance versus the S&P 500. You can see we tested that trend in April. That corresponded with this test of the 200-day moving average up here in the comp, and we started a new leg lower. Came down and tested this support. So now we've relatively outperformed in the comp, testing that 63-day moving average again, which, by the way, is one business quarter, and it's also Asbury Research's strategic time period. We're starting to roll over. So we've got kind of like a push me pull you here. We've got support underneath on the outright chart at 10,823 to 10,519 that's holding the market up. And then up the top side, pushing it down, is this relative performance trend. So how we resolve this, both relatively and outright, is going to tell me a lot about what the health of the market is. And without leadership from tech, the market's going to have a really hard time building any kind of a sustainable rally. Number 3, volatility, too high for a sustainable rally. For volatility, we have the VIX here, and this is a daily chart that goes back to January, S&P 500 up top, for perspective, and down here is the VIX daily. We put a 21-day moving average over the VIX because that is our tactical time period. But the most important part of this chart is this 24 horizontal green dashed line that's running right through the middle of the VIX part of the chart. For the past couple of years, 24, in our view, has been the fulcrum. It's been the line of demarcation between a tactical uptrend in the S&P 500 and a tactical downtrend. So you can see here on April 22nd, right here, we rose up above 24 and we've stayed there since. So going straight up the chart, this was right about here in the S&P 500. Very interestingly, when the S&P was trying to get to that 4170 area in the beginning of this month, from June 2nd to 9th, the VIX was sitting right on top of 24 here, trying to break it. I was watching this like a hawk every day, thinking if we could break 4170 in the S&P and we could hold 24 in the VIX, we're going to start the next, we're going to kind of shift this little rally into second gear and maybe take it up to some larger resistance as we get up the chart a little bit. It never happened. As long as the VIX stays over 24, it's going to indicate that the market is too nervous, it's too apprehensive to mount a sustainable rally, and we're going to look at these little rallies like the one we're having right now as more likely to be short-lived and relatively shallow. Number 4, investor sentiment, market nearing a strategic bottom, possibly. And here's what we're looking at here. As we're looking at the tacticals, I want to see how this fits in with the more strategic outlook. We have a lot of different ways that we do that here. One of those ways is to look at various investor sentiment tools. This is the investors' intelligence data. Asbury Research is actually one of the inputs for their data. And this is the bulls minus bears part. They have different ways to look at this data, and the one that we like, or one of those that we kind of favor, is the bulls minus bears. So what we have here is a weekly chart of the S&P going back to 2010 up top, and then the weekly survey down at the bottom. And what you see here is we're at a least bullish extreme, have been for a month, maybe 6 weeks, and you can see going back across the chart all the previous times that we were here. March 2020, Jan 2019, March 2016, Sep 2011, Sep 2010, were all either at or close to what I would argue were the most important bottoms in the S&P 500 throughout this whole period. So this is not a tactical tool. This doesn't tell me to buy the S&P 500 today or start to be aggressive today. What this tells me is one of these next couple of tactical signals that we get from the Asbury 6, from our correction protection model, from the VIX, from maybe breaking a resistance level, from maybe some outperformance in the NASDAQs, that could be another one of these really important bottoms like we had right here in March of 2020, right at the bottom of the COVID collapse here. So again, looking at this, I'm paying a lot more attention to the tactical right now because my goal is to try to get involved in the next significant leg higher, and to be able to take a lot of this money that I've had on the sidelines this year because our Asbury 6 has been negative for most of the year, and reallocate that lower and then be able to hold that as it starts to perform. Finally, I wanted to look at our SEAF model. Our SEAF model, SEAF stands for Sector ETF Asset Flows. I built this model 5, 6, 7 years ago, and what it does is it follows the asset flows around the 11 sector spiders, which together represent the S&P 500. Why use the asset flows? Is because the sector rotations, for the most part, are a lot faster these days. You might get a sector rotation trend that lasts 6 or 7 weeks, where 10 years ago, a lot of them were lasting a quarter or two. Now, if we're lucky, we get 3 or 4 of them that last a quarter or two. We just had one in energy. So this is getting us on those trends faster. And then if the money leaves those trends, then we're out of there very, very quickly. And the end result is it gets us into those 3 or 4 good trends that we have every year. It gets us in there early before we can actually see the trends start to show up on the relative performance chart, and it keeps us there until the money leaves. So let's look at SEAF right now. The latest data, according to our model, indicate a continuation of the 310 trend of inflows into healthcare. Healthcare has outperformed by 10%, outperformed the S&P 500 by 10% since 310, since the signal showed up in SEAF. And we have a new trend of inflows that's going into technology just as of last week. So another piece of the puzzle here. While the comp is trying to hold support and the relative performance, relative trend of underperformance versus the S&P 500 is being tested, we had some money pretty aggressively go into tech last week, go into XLK last week. I want to see if that money holds. If that money is out of there this week and we update this model on the weekends, if that money leaves there and goes somewhere else, that's going to tell me a lot more of what I can expect from that chart that I showed you, showing the support in comp and showing the relative performance. If that money stays in there, now I've got a little bit more optimism that we can start a big move higher from here. The last thing I wanted to point out, because we've been talking here all year about our January 10th overweight in the energy sector. The SEAF model actually moved out of energy at the end of last week, so it's no longer in the model anymore after outperforming the S&P 500 by 40%. So, and that's been the only sector that has made any money this year. I just checked prior to making the video for you this morning, and energy has been in. We were fortunate enough to get on that trend very early because Steve showed us the money was moving there. So there you have it. Some really interesting stuff here heading into the rest of the summer. A lot of these indicators, I think, are on the brink of giving us a potential good opportunity to get back into the market, or at the very least, let us know that there is still some danger there so we can protect our assets, protect our capital. So thanks for watching. If you like our approach to investing, I invite you to visit us at asburyresearch.com, or you can subscribe to our YouTube channel. Thanks for watching, and we'll see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.